Good morning. Thank you very much for listening in. And let's start straight away with the first slide. And I'm pleased to say that's a good slide. It shows the performance of the fund over the last three months, the year, last year. But you can see on almost every period, the fund has outperformed both its peers and the index. The one we're most proud about is the one on the right. Since inception, you can see that the fund has done since inception 15.5% compound. Now, there are not many funds in South Africa that have done that. And as the next slide shows, you can see the top line there is the Nedbank Financials Fund. And you can see what 15.5% compounding does over such a long period. It's actually outperformed both the JSE All Share and it's outperformed the MSCI World, in both measured in Rand. So it's quite extraordinary for a financial fund as to outperform consistently both the JSE and the MSCI World. Interesting, you can see there the third one there is the Denker Global Financial Fund, in which this fund is a 20% investment. Surprisingly, the SA fund has still outperformed that. It is amazing. And I think it's because some of the stock picking that we do in this fund, which we'll show a bit later. So if you look at the attribution analysis, this is just for the quarter. The biggest contributor for the quarter past was Investec. It gained 52%. I'll show you later how cheap that was. And then the Denker Global Financial Fund also did quite well, 14%. Part of that was also, in fact, the Rand strengthened over that period. It actually did better. But OUTsurance is another one. By the way, on all the slides, the OUTsurance numbers are wrong because of the unbundling. It was RMI and there were a lot of shares unbundled, and FACTS don't really know how to handle that. If you look at the detractors was once again stock picking. Transaction Capital has been an outperformer for quite a number of years, and it just got too expensive. And look, with hindsight, we should have taken some profit. We really like the company. We think it's very well positioned, but it hurt us this year and in this quarter. And same, you'll see the biggest detractor was Sanlam. Got a very large weighting in Sanlam. The insurance sector as a whole underperformed and did poorly, Old Mutual, MMI and Sanlam. And a lot of that was with the very high mortality, the death claims post-COVID, and on the insurance, short-term insurance side, the floods and the fires. So Sanlam detracted. And then also Standard Bank, where we were underweight. Standard Bank, we were underweight mainly because very concerned about a couple of things that were happening there, especially specifically on the IT side. They had a lot of outages, system failures, but we had a very good meeting with the management team towards the end of the year. And I must say, I'm impressed, and it looks better going forward. If you look at the full year contributors, again, you can see the biggest contributor there was Investec for the full year, and then ABSA. And the ABSA one is interesting, and I highlight that weight of 9.7. At one stage, beginning of the year, we sold it down to almost zero when they had their management problems, when they appointed a CEO, and then he tried to go a different route, and they came to agreement that he should leave the group. And we thought, as we don't want to be invested in bank that is managed in this way. But since then, we've had very good meetings, also with Ari Rotenbach, the CEO, and very impressed with ABSA. So I'm glad that we managed to get our holding back and the share performed well. The other contributors were really shares we didn't own, like Old Mutual, Quilter. Interesting, just on Momentum Metropolitan, you can see that if you look on the total return column, it's minus 3.6, but in the fund it's plus 6.6. And that's really because we were watching it the whole time until it got too cheap, and we only bought it right at the end of the year. So we got a positive return from that, but during the year for the index, it was negative. Okay, the detractors on the full year was, as I said, Transaction Capital, Sanlam, and then the Global Financial Fund, which did -10. But obviously in rand terms, that was worse. In fact, that number should be 4%. If you look at the top 10 holdings, don't look so much at the individual holdings. Just look at the dividend yields. And you see the average dividend yield of the fund is just over 5%. Again, if you look at the column next to that, the PEs, the average PE is 10, but that average is taken up by Capitec and by Outsurance. If you take those two out, you can see the average P is closer to 8. Financials are still very cheap. I've got a slide here after to show you that. Again, you can see it on the return on capital. Our forecast return on capital is on average 20%. And that's, by the way, how the fund does over time a compounding of 15%, because the shares that generally we own in the fund generate a shareholder value growth of 20%. And every now and then you have one who doesn't and you lose, but over time, that's where you get 15%. And again, the price to NAV is actually low. If you look on average, look at Nedbank there, trading at 1.1 times book for a return on capital of 16, similar with Standard Bank and Absa. The next slide, I flesh that out a bit. Just look at FirstRand. Oh, no. Let's first go back and look first at the shareholder value growth, SV growth, and then the total return. Shareholder value growth is what management did with the capital plus dividends paid out. And you can see on average that was 22%, ignoring the Outsurance at the bottom. It's the 9, the average of the 9 shares. If you look at the total return, then that's 16. So what you can see, the sector actually derated. So shareholder value growth was stronger than what the total return was in terms of share price plus dividends. And you can see that in the price to NAVs. And I've just highlighted a few there. Look at FirstRand. You can see in 2019 that it was a price to book of 2.76. It's now a price to book of 1.78. Similar to Standard Bank, Sanlam. You can see how expensive Sanlam was in 2019, 3.6. It's now 1.6. So it's sold down a lot. These shares are sort of very undervalued, and we'll come back to that at the end. Okay, just on the ESG scores, glad to report that generally you can see everywhere managements do take it seriously. There are a few smaller companies, Outsurance, MMI, Capitec. You'll find smaller companies first focus a lot on growing shareholder value. The bigger you get, the more time you have to actually concern yourself with ESG scores and making sure that you tick all those boxes. But the one that deteriorated was Sanlam, and that's really because of the Competition Commission's investigation into in the industry on collusion. Okay, to wrap up, the financial sector is expected to benefit from the environment of higher interest rates. So higher inflation means higher interest rates. The second one, very important, is whilst financial sector benefits from higher interest rates, industrial companies' profit margins are squeezed, both because you get lower growth, but also because you get, due to your gearing, you get a higher interest paid factor. And so we think the financial sector relative to industrials, profit growth should still be better on the financial side. And also both banks and insurers remain mispriced. And if indeed they are going to surprise and show higher earnings growth in industrial companies, they should re-rate further. And then finally, just a 20%, it's now 22% investment offshore via the Denker Global Financial Fund. That benefits when the rand weakens. And in any case, at the moment, we think it's more exciting because of the holdings in US and EU banks, which are particularly mispriced, and also growth from emerging market banks that the fund holds. And thank you. It's an important question, both globally and in SA. Globally more so because interest rates have come from very, very low levels. In Switzerland and Europe, interest rates were negative. So I think investors are missing or not understanding two factors. The one is the impact of higher interest rates, both on the investing world and on the real world. So for investing world, expensive companies get repriced downwards, but your financial companies benefit from higher interest rates. And so I think your financial companies will do better than most investors anticipate. But I think the second one is more important, and that is that few investors realize, because of what we could call the curse of complexity, regulators have really made the environment in which banks and insurers work very complex. But the bottom line of all that new regulation post-2008, it's made it very, very difficult for banks to build a risky loan book. So the banks have avoided risk. So our forecast and prediction is that 2023 investors are going to be surprised as to how low the bad debts are in a recessionary environment. And if we are right, then you're going to really see a further re-rating, because the ratings of banks globally and in South Africa are still anticipating a high level of bad debts, and we don't think that will happen. So I really think that's what investors are missing. So if you look at those 20 years, one of the contributors to the fund's outperformance and strong performance has been our ability, because we understand the sector, our ability to spot up-and-coming shares. For a long time, that was Capitec, it was PSG. Many years ago, it was Coronation, Investec, Transaction Capital a few years ago. We think the one that this year was unbundled last year and will this year start a period of 3 to 5, 10 years performance is Outsurance. It's really the company we're excited about, gotten to know management over the years, also through our holding in RMI. But it's a small insurer. It's got none of the baggage in terms of systems of other insurers. It's still very focused on what it does. It reminds me a lot of Capitec when it started. But as it's successful, and this is our view, as it's successful in what it does, it can do two things. A, it will grow new products, and it will grow clients. And if you do that, you grow new clients. Every new product you add, you actually get the so-called flywheel effect. So we think Outsurance is the one that could outperform for the next few years, and we're quite excited about that. We had a few that was unbundled out of RMI in the fund, and we've actually been buying more. It's not cheap now, but if you look back at Capitec, it was never cheap. So if this is the next Capitec, then it's still good value. As we stand here, we're very despondent, despite it being start of a new year, because of load shedding, because of what's happening within the ANC, what's happening in government. So, the growth outlook for South Africa isn't exciting. Loan growth will be low. It will be constrained. It will be difficult. But firstly, that means loan growth and premium growth for banks and insurers will be lower. But remember, an inflationary environment is, funny enough, actually good for banks and for insurers. Banks, because of your working capital needs of your clients and just financial needs of your clients. So generally, your loan book still grows with inflation. So even if inflation is 6% and let's say growth is, if we're lucky, 2%, you still get loan growth of 8%. On the insurers, you're going to see significant further premium hikes because of still the results from COVID. So they'll do well through premium growth. So bottom line is we think the top line growth should be fairly good. The focus is going to be on expense curtailment and keeping bad debts low. And then because of those low valuations, our own anticipation is you should see some further re-rating, maybe because you've had such a strong year last year in terms of price performance on the banking side. Investors are a bit hesitant. But I think if you, at the end of this year, we stand back, the sector should have given you 15%. And as you can see in those, the 15% compound over 20 years, every now and then, if you hold this fund for 3 or 5 years, every now and then, when South Africa grows faster, you'll get a very good growth at 20%. I think the important thing to remember in this fund is that it's top quality franchises. We've got very good management teams in South Africa, and they're also growing outside of South Africa into Africa, where the growth rate is higher than South Africa. So, yeah, bottom line, I'm still very excited based on the valuations and on the, although lower, but still good growth expectations.